Here's the big question for you. Is there a secret bias hidden in mortgage approval algorithms? Here's a real story for you as it's been told by the Markup, an American non-profit organization based in New York City. Two people applied for loans in Rochester, New York. They both earned $30,000 to $45,000. And they both struggled with debt. However, the white applicant was approved, while the black applicant was denied. Here's a graphic for you showing a number of examples from throughout the US where people of color were not given mortgage loans while white applicants with similar financial situations were approved for their loans. It is based on people in financially similar situations based on their location, their annual income, their debt-to-income ratio, and the amount they were looking to borrow relative to their home's value. Yet, for some strange reason, people of color have been denied, while white applicants were approved. How come? Watch this video to find out why.
In the United States of America, loan applicants of color were 40% to 80% more likely to be denied than their white counterparts, a study by the Markup, an American non-profit organization based in New York City, has found. In certain metro areas, the disparity was greater than 250%. Even while accounting for factors lenders said would explain disparities, people of color are denied mortgages at significantly higher rates than white people. The new 4-bedroom house in Charlotte, North Carolina, was Crystal Marie and Eskias McDaniels's personal American dream, the reason they had moved to this southern town from pricey Los Angeles a few years ago. A lush, long lawn, 2,700 square feet of living space, a neighborhood pool and playground for their son, Nosret. All for $375,000. Pre-qualifying for the mortgage was a breeze. They said they had saved much more than they would need for the down payment, had very good credit, scores of 805 and 725, and earned roughly 6 figures each, she in marketing at a utility company and Eskias representing a pharmaceutical company. The monthly mortgage payment was less than they'd paid for rent in Los Angeles for years. They were scheduled to sign the mortgage documents on August 23, 2019, a Friday, and were so excited to move in they booked movers for the same day. The Wednesday before the big day, the loan officer called Crystal Marie, and everything changed, she said. The deal wasn't going to close. The loan officer told the couple that he had submitted the application internally to the underwriting department for approval a dozen, 15, maybe 17 times, getting a no each time. The couple had spent $6,000 in fees and deposits, all non-refundable. As it appeared, it was getting rejected by an algorithm. Nevertheless, she was told she didn't qualify because she was a contractor, not a full-time employee, even though her boss told the lender she was not at risk of losing her job. Her co-workers were contractors, too, and they had mortgages. Crystal Marie's co-workers are white. She and Eskias are black. An investigation by the Markup has found that lenders were more likely to deny home loans to people of color than to white people with similar financial characteristics.
Create the life that you love. Get yourself a life coach. Email me at michael@coachacademy.com.
Holding 17 different factors steady in a complex statistical analysis of more than 2 million conventional mortgage applications for home purchases, the Markup found that lenders were 40% more likely to turn down Latino applicants for loans, 50% more likely to deny Asian Pacific Islander applicants, and 70% more likely to deny Native American applicants than similar white applicants. Lenders were 80% more likely to reject black applicants than similar white applicants. In every case, the prospective borrowers of color looked almost exactly the same on paper as the white applicants, except for their race. The Markup found that the lenders gave fewer loans to black applicants than white applicants even when their incomes were high, $100,000 a year or more, and had the same debt ratios. In fact, high-earning black applicants with less debt were rejected more often than high-earning white applicants who have more debt. So, the Markup sent their complete analysis to industry representatives, the American Bankers Association, the Mortgage Bankers Association, the Community Home Lenders Association, and the Credit Union National Association. They all criticized it generally, saying the public data is not complete enough to draw conclusions, but did not point to any flaws in the Markup's computations. Yet, the question remains: who makes these loan decisions? Officially, lending officers at each institution. In reality, software, most of it mandated by a pair of quasi-governmental agencies. This algorithm was developed from data from the 1990s and is more than 15 years old. It's widely considered detrimental to people of color because it rewards traditional credit, to which white Americans have more access. It doesn't consider, among other things, on-time payments for rent, utilities, and cell phone bills, but will lower people's scores if they get behind on them and are sent to debt collectors. Unlike more recent models, it penalizes people for past medical debt even if it's since been paid. This is how structural racism works. In fact, any type of data that you look at from the financial services space has a high tendency to be highly correlated to race. Thank you for watching.